Later this morning. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research as traders look ahead to the US election. Ed Mills of Raymond James as Harris and Trump head into hostile territory. And former IMF First Deputy Managing Director John Lipsky as the IMF's annual meeting wraps up. We begin this hour with the S&P 500 heading for its first weekly drop in 7. Traders dialing back bets on Fed rate cuts and weighing election risk. Jim Bianco of Bianco Research looking to the betting markets for clues on the election outcome, writing the power of the betting markets is that they can react quickly to new information, such as a political event and/or an October surprise. Trump is trading in all markets greater than 50% and has been in an uptrend for weeks. Jim joins us now for more. Jim, welcome to the programme, sir. Let's start with the betting markets and compare and contrast them with what you're seeing in the polling data. How big is that spread?
It's not very big at all. Most of the polling, most of the election modelers have got Trump slightly above a 50% chance of winning the election. The betting markets are supposed to take that into consideration and anticipate what's coming next. As you mentioned, Trump is in an uptrend, and it's been in an uptrend, and he's trading in the low 60s in the betting market. And so that seems to be appropriate. And the reason I bring that up is if the markets are manipulated, you would say that they're at some unexplainable level. But I don't think that these markets are at an unexplainable level. And the last thing I'll point out is these are probabilities. These are and probability of 60%. A lot of people have a hard time getting their head around what that means. And I've used the analogy that it's less than a 3-point lead in a football game, and a stop and a field goal by Harris could win the game. So it's not that hard to turn it around. But Trump is leading, and the betting markets seem to be appropriately priced.
Jim, when it comes to the betting markets, though, we know there's one big outsize, almost whale when it comes to this French trader. Is that potentially why we see Trump moving ahead, just because there's these outsized moves in the betting market where it's not going to pick up in the polls?
Yeah, no, not really, because there's 10 betting markets. They're all kind of saying the same thing. The volume in the betting markets has doubled in the last week. It will probably double again next week. It always does in the final days before the election. There's going to be probably more whales that come into this market as well, too. It really looks like it's somebody who's got a strong conviction and put a lot of money on that conviction as opposed to a manipulator. And that's why I say that if you look at the polls, you look at the election modelers, where should this market be trading? About where it is right now. So it seems that everything's appropriate.
Do you think that financial markets are looking more at the polls or at the betting markets?
You know, they both kind of look at each other, because there is, whether you're talking about Trump media, DJT, or you're talking about Bitcoin, or if you're talking about the defense stocks versus the technology stocks, they've all got some kind of embedded election play in them, and they're all kind of feeding off of each other. The bettors are looking at those markets are looking at the bettors. And so it's kind of a reflexivity that you see going back and forth between those markets.
So, Jim, we need to talk about how well priced the Trump presidency and/or GOP sweep might be. And with that in mind, and I've seen this a lot from the fixed income side, from a lot of strategists, asking themselves whether risks are skewed asymmetrically to lower yields because of how well priced the Trump presidency might be. How are you thinking about the balance of risks into the next few weeks?
Well, I think still the balance of risks is still going to be higher, because if we were to get a Trump presidency, and again, it's not a lock, you'd be looking at tariffs, and that's a form of inflation. You'd be looking at tax cuts. That's a form of stimulus. And you'd be looking at an economy that is going a lot stronger. And I think what the bond market has been bothered by has been the Fed moving 50 basis points in September. It's not 50 that bothered them. It's the signal, as Austin Goolsbee, the Chicago Fed president, said, that they've got hundreds of basis points to go. And I think the bond market's looking at this and saying, well, if we're going to get tax cuts, we're going to get potentially more inflation through tariffs. We don't need hundreds of basis points of rate cuts. That's just going to be piling on to potentially create more of a stagflationary type of environment. And that's why you've seen the 10-year yield move up 60 basis points since the day the Fed cut rates on September 18th. It hasn't bothered the stock market yet, but I think at around the 4.25 level is really anything above that is where the stock market really starts to run into problems with the rise in rates.
Jim, let's build on that. 460 that morning on September 18th, as you suggest, 60 basis point move. If you believe the path of least resistance is still for high yields from here, what kind of numbers are you thinking about?
Well, let's look at some of the numbers in the past. In April, we hit 475. October of last year was the high since the pandemic, where we hit 5%. I think we could probably go back and at least revisit some of those numbers, probably in the first quarter, if we do see this burst of activity come through tariffs, through a stronger economy. And let's not forget, whether who wins the election or not, that the economy has been picking up steam in the last few months. And now with the hurricanes and the strike, I heard you mention the payroll report, all that's going to get muddied for the next few months as we try and figure out what the path of the economy is going to be. But it was picking up before that. So all of that does augur for much higher yields. And that's why I think we could at least go back to the April highs by the first quarter, if not, press that 5% level that we saw last year.
Jim, let's get to the jobs numbers next week then. NFP about a week away. 120 is the median estimate in our survey. What's curious about this moment in the labour market is that jobless claims came out yesterday, back to pre-hurricane levels. And Jim, I'm trying to work out if the risk for next week is actually a stronger number, stronger than some people are expecting. What are you looking for?
Exactly that. I was very surprised by the claims number 2. If you look at during Katrina in 2005, or Hurricane Harvey in 2017, which came ashore at Houston, the claims numbers jumped 50,000, 75,000, and gave you a clue that you were going to see a very depressed payroll report. In both of those instances, the payroll report was negative for that month on the first release. But you're right, the claims numbers have actually returned to where they were pre-hurricane, returned to where they were pre-Boeing strike. I'm sure there's a lot of suppliers that are laying off now with the Boeing strike, returned to where they were pre-Stellantis layoffs that happened a couple of weeks ago. And that does open up the possibility that we might not see any weather impact in these numbers, and maybe a bigger number that might be truer reflection of what the economy is saying at a time when we didn't think that those numbers would show us a reflection of the economy.
Jim, is there a number in mind that you have that would put the Fed on pause?
On pause for November 7th, probably not. I mean, the market's, priced 90% chance that the Fed is going to move, and they've got 1 week before they go into their quiet period. Even a strong number, if it's another 250,000, I don't know if that would be enough to get the Fed to pause in November 7th, but December would be open for a pause, even if they were to move in the next 2 weeks.
Jim, I think that is the question. What would it take to get Nikki Leakes to write an article to say that maybe this wasn't going to happen? Jim Bianco of Bianco Research. Jim, it's good to catch up with you, sir, as always. I mentioned